So chapter 5 gives us an overview of merchandising operations. So any company that their main business is buying and selling products, goods, we call it, right? So we're going to be focusing on that and the role of inventory in this. And then later in the chapter, you'll be introduced to a more expanded income statement called a multi-step income statement, which is an awesome financial statement, in my opinion. Today's focus is learning objective 1. So here is the overview. you've all been shopping. That we know. We've all been to some type of merchandising company. Right? You've probably been in a Walmart. You might have purchased things on Amazon. You might not have heard of REI. It's called Recreational Equipment Incorporated. It's more like a Dick's Sporting Goods and a Cabela's kind of mixed together. They don't have any stores in this particular area. I have seen a couple up in Massachusetts when I visited there. But these are all merchandising companies. Merchandising companies, they exist to buy and sell goods. So a good is a product, right? So what you walk into a Walmart, you're not walking in there for anything other than to buy products that are on their shelves. And so they specialize in buying and selling goods. The interesting thing is the whole cycle of what happens. So you and I are sort of at the very end of the cycle here. This is us as consumers, right? We go into retail stores, we look at merchandise, and we check out all the prices that are on that merchandise that we're interested in buying. Okay, the prices that you and I pay for any type of stuff at a retailer or merchandiser is their revenue. Their revenue is called sales, or sales revenue is the official title of the account. It's called revenue, sales revenue, because it's specifically related to goods. Excuse me. So if you see a financial statement, an income statement for a company, and it says sales or sales revenue, they're selling goods. That's their main operation. Okay. Now, you and I are paying certain prices, but before you and I ever walk into a store to look at the prices, that retailer has a lot of work to do. Okay. The first thing they have to do is to make sure there's stuff for us to look at when we walk into their store. And so they actually have to buy those goods first. Now, they don't often buy from a wholesaler. This is sort of an older model, and some industries still use wholesalers. But most businesses, particularly when we're talking about places like Walmart and Amazon, they deal directly with manufacturers. Okay. And I cannot spell on my Mac for manufacturers. Okay. Very bad writing. So a manufacturer basically are companies that create products, they design products, and then they make them. So I think a lot of Americans, when they think of manufacturers, they think of that last part, the making piece, the factory jobs and all this other stuff. But manufacturing is significantly bigger. Before you can make anything, it has to be created. And that's probably the most important part of the manufacturing that we do in the United States. We still lead the world in new products. So in other words, new ideas and new goods that are being created. And we can see that because of the number of patents and copyrights and other things that have been awarded for these types of inventions, goods, products, and processes, etc. What Americans often point to when they think of manufacturing is the actual making of the product. That's the last step in the manufacturing product process. The first step is, of course, we have to create things. So Walmart, like retailers like Walmart, deal directly with manufacturers. They have to buy those goods first. So when they're buying those goods, right, that means Walmart and other retailers have to fork out money first. So there's a cost that automatically happens when they're buying the goods. It's costing them money. Okay, that in those goods are an asset to the company. We call that asset inventory. And you've been introduced to inventory from back in chapter one and again in chapter two when we talked about different asset accounts. And you probably know inventory is a current asset because the whole purpose of inventory for a store like Walmart is to sell it. Right? It's a short term asset. They want to buy it and then they're going to turn around and sell it to the customer. Okay. So, but look at before you and I walk into the store, look what they have to do, right? They have to set up a relationship with manufacturers to buy those goods. So there's a cost to them. They put it in their store. They own that. That's inventory. And then they go ahead and sell it to us. The prices that they put on the merchandise, right, reflects the revenue that they're collecting from selling those goods.
What would
So,
Amazon be? Because they kind of
well,
sell people's products for them.
yeah. So Amazon's they do they're a multifaceted company. They started out basically as an online bookstore back in the day, and of course they've included various merchandise now. But Amazon makes a lot of their money not from selling goods, but their increasing amount of services that they provide via web and these platforms for other merchants to sell their stuff. They make money that way. So we can still look at Amazon as a merchandising operation because it's a pretty large part of their business, but it's not the only part of their business. Whereas Walmart, it's the only thing Walmart does. Walmart doesn't have any other types of things that it's doing for customers other than selling goods. And so that's more of a pure play for Walmart than it is Amazon, to answer your question. But they still go through the same thing. I mean, Amazon sells lots of different products. There are a lot of Amazon products, right? They have to buy that and put that in their warehouses, ready for customers to buy it and get it shipped to them right away, right? So again, the prices that we pay is the revenue for the company. At that point, this asset has been sold, right? Starts as an asset. Once they sell it to the customer, they expense the cost of that inventory. We call it the cost of goods. Okay, so you're going to learn about that as
Would
well.
the manufacturer enter it as a sales revenue too when they sell it to the retailer?
Yes, we will. Learning objective 2 and 3 deals with business to business transactions. So between, say, a manufacturer and a retailer, you'll see that in the next two objectives next week. But right now, just general concepts of understanding the system is what I'm trying to get as an overview here. So again, that's the whole thing. How does it play out on their financial statement? Well, they measure their income a little bit differently. Their income statement is a little bit more detailed than what we looked at in Sarah Corporation, which was just a service business, right? You had revenue minus expenses gives you your net income. As you see, for a merchandising company, it's a little bit more complex. First and foremost, their revenue account is called sales or sales revenue. Whenever you see that sales or sales revenue, you know that the company is selling products. The first thing they do is subtract out the cost of the product. That's the cost of goods sold. Cost of goods sold is a name of an account. It's an expense account. Okay, so this is a new account for you. It's an expense account, cost of goods sold. And again, remember, they had to buy that before they sold it to us. So whatever it costs them is what they're subtracting out here. Okay. The difference between the sales revenue and the cost of goods sold is something called a gross profit. And that's all a gross profit is. The difference between what what the customer is paying in the terms of a price, right? So what the customer is paying as a price is their sales revenue minus the actual cost of the item. That's really what a gross profit is. Okay. Notice only one expense has been deducted so far. Cost of goods sold is just one expense. It's the cost of the inventory. From that gross profit, all the other expenses that we've talked about are subtracted out. And that gives us our net income or net loss. So these are very, very important types of things, what you have to know, right? Sales revenue is the revenue account. Cost of goods sold is the cost of the inventory they had to buy to sell it to us. Gross profit is the difference between those two. And then the net income is after all the operating expenses are subtracted from the gross profit. So all these are very, very important to know. Merchandising companies have different operating cycles than a service company. We've been looking at Sierra Corporation, who did tours, and it's a relatively simple operating cycle. They perform the service, either they collect the cash right away or they have an accounts receivable, which turns into cash. So it's a relatively simple cycle, and thus it's shorter. For a merchandising company, again, their cycle is significantly longer because the first thing they have to do is buy inventory, right? You can't walk into a store without them buying all that stuff first because there'll be nothing on the shelf. And of course, they're constantly buying inventory because you don't want to walk into a store and see their bare shelves. They want customers to walk in and see that there's plenty of options for them. That's so they're always buying new inventory because they're always selling inventory. Again, inventory is a very important asset account that you have to know. It's a current asset because the purpose of the inventory is simply to sell it to generate revenue. Okay. So again, they get cash, they buy inventory, they sell inventory. That's their entire business. Sometimes they sell inventory and they'll get the cash right away. Sometimes they'll sell inventory to other businesses, in which case they will set up a receivable, in which case they will receive the cash later. And thus the cycle, as you see, is a little bit more complex and thus takes a longer period of time. It's very important to understand that we're always tracking inventory. We're always tracking inventory. And this particular flow chart, you're going to see over and over again a couple of times in this chapter. So I'll review it here and you'll be practicing it later on. Everything starts with, again, because this is we're tracking inventory, we're going to be doing it on a time basis. So let's say at the very beginning of a period, say it's the first of the year, you're starting off your year with so much inventory in your store. Okay, that's the beginning inventory. Well, so that's the very first step. Okay. What you're going to be doing is you're always going to be buying more inventory. Okay, so you'll be making lots of purchases of inventory all the way through the year because you're always going to be stocking your shelves. Right. The sum of your beginning inventory and your cost of all the goods you purchased is this middle box right here. Okay, this is basically the cost of all the money you spent on inventory available to sell. So only two things, the good news is only two things can happen to inventory once a merchandising company buys it. At the end of a period, so I'll just put this down as the end of a period here. Okay. At the end of a period, they will count up their inventory and whatever they own is still their asset. That's the ending inventory asset. If it's not there, they've assumed they've sold it. Okay. Cost of goods sold is an expense, as I mentioned here. And again, hard for me to write on this. So cost of goods sold is an expense. Again, only two things can happen to inventory that a company buys. At the end of a period, they count it, it's still there, it's their asset. If it's missing, they assume it's been sold and it will be expensed. Okay. Now, how do companies keep track of all this flow? Well, most companies use something called a perpetual inventory system. And a perpetual inventory system means the inventory system continually updates the amount of inventory in the store. Okay. So you basically have this idea that um, most companies in Five Below, Walmart, others, Amazon for sure, they are continuously keeping track of their inventory using a computer system, right? Every product has a barcode, and they basically scan everything in for the record. And then, of course, when you sell it, when the customer buys it, they scan it out, right? When you go to the cash register, boop, that little boop records a lot of different things, including that you're down inventory. You just sold your inventory. So they're perpetually keeping track of that. That's the perpetual inventory system. However, there are smaller businesses, much smaller businesses, that have to do it by hand on a regular basis. And normally you would count inventory. I would say a lot of companies count inventory either monthly or quarterly, but they literally physically count the inventory. That's a periodic inventory system. They basically start physically counting the items and comparing it with what they have on their records to keep their records updated. Um, and again, very back in the day when I was your age, that was the system for most businesses. Most businesses were very small and they were not computerized. However, today there are still businesses that do it this way. There are just not a lot of them, okay? Because there's so many great computer systems to allow you to do a perpetual system. But even companies that use a perpetual system have to do at least an annual physical count. They are literally at Walmart during a particular point in the year, or Five Below at a particular point in the year. That retailer is doing a physical count. Literally, this is what the computer says we have for children's aspirin, chewable children's aspirin bottles of 20. 1, 2, 3, 4, 5. That's what it says. But I only counted 4. Well, that's the purpose of a periodic system, is to make sure your computer system records are accurate. So a physical count basically double checks to see if it's accurate. So again, a perpetual system continuously shows inventory. And these are awesome because, not only are you scanning inventory as it comes in? So as deliveries come into a store, you're scanning it in. And as sales are happening, it's being scanned out. But also that system is indicating at a certain point in time, there's a low level of inventory that needs to be replaced. So it's automatically sending a message to the warehouse saying, look, Walmart store 1405 in Fishkill needs this, and this for its inventory. Get it on the truck. Right. So it's very important to know that this system is for the entire company, not just for one little store. It's all interconnected. Okay. So here's the periodic system in action. That was the chart that I gave you earlier. Said you're going to see it over and over again. At the beginning of a period of time, we start with so much inventory in the store. We're always buying more inventory because that's what we do. We sell inventory. We buy it and sell it, buy it and sell it. So we add all the inventory we bought. That gives us all the inventory we had available for sale in that period of time. And like I said, only two things can happen to inventory from an accounting perspective. You count it up. If you still own it, it's an asset. If it's not there, we assume it's been sold and we expense it. Okay, so this is the tabular form of what that chart was earlier, and you're going to see that again and again and again. So here's the do it exercise for learning objective 1, summarizing your introduction to merchandising operations and inventory systems. And there's simply a few statements that it looks at. First statement, the primary source of revenue for a merchandising company is performing services. No, it's selling goods. It's selling goods. That's why that's false. Right? That's important to know. Sales revenue is from selling a good. Service revenue is for performing a service. The second thing here is about the operating cycle of a service company is being shorter than that of a merchandise company. Yes, that's true. Because as a service company, you're just performing a service and you're getting paid, right? Well, a merchandising company has to buy all that inventory to get that sold before they get paid, right? So it's just simply a longer cycle because there's more steps involved. The third thing here is sales revenue minus cost of goods sold equals gross profit. That is true. As a matter of fact, I would say, I don't ask you to memorize very many things in this class, but this is something you have to know. That is definitely something you have to know. Sales revenue minus cost of goods sold equals the gross profit. Definitely something you need. And the last one here, ending inventory plus the cost of all those goods that you purchased equals all the cost of the goods available. No, it's not the ending inventory that you start with. You start with the beginning inventory. Then you add all the goods that you bought. Then that equals all the goods available. So that's why that is false. Okay. So important stuff to become familiar with. This chapter starts us on a whole new road for a topic that we're going to get deep down into regarding inventory. Any questions?